In the world of investing and financial management, there are a set of principles that guide how we manage our money and make decisions. Among these principles, a few concepts and practices stand out, often challenging conventional approaches. In this review, we explore a range of ideas about asset allocation, diversification, risk, and investing in yourself. From critiques of popular capital allocation strategies to the importance of effective communication and personal investment, each topic offers a unique perspective on how to optimize and protect your wealth. Let's explore these themes and see how they can shape your financial decisions for long-term success. Cash allocation. Cash allocation is a crucial issue in financial management, and understanding how to manage available cash is essential to optimizing investment performance. The traditional approach of holding a fixed percentage of cash, as recommended by some Wall Street strategies, may seem like a safe approach, but it is often not the most effective. Rather than simply keeping a cash reserve for the sake of it, the goal should be to ensure that every dollar available is being put to productive use. The idea of maintaining a fixed cash position, such as 60% in stocks and 30% in another asset class, is a common practice, but it's not necessarily right for all investors. This strategy may seem absurd to some, especially when the goal is to maximize investment returns. The key is to find deals and opportunities that are actually worthwhile, rather than just following rigid rules. Cash can come from a variety of sources, such as asset sales or unexpected inflows of funds. When this happens, there may be a temptation to quickly allocate this capital to maintain a pre-established strategy. However, it is crucial to consider whether there are real opportunities that justify this allocation. If there are no promising investments at the moment, keeping the cash in cash may be a wiser choice. The challenge is to find productive ways to use the available capital. Rather than simply letting money sit idle, it is more beneficial to look for ways to deploy it in opportunities that bring value and growth. This may mean waiting for a more attractive investment opportunity or adjusting your investment strategy based on market conditions and opportunities that arise. Therefore, the approach to cash allocation must be more dynamic and flexible. Rather than being tied to fixed percentages or rigid rules, the focus should be on maximizing the use of available capital in an efficient and productive manner. This requires constant analysis of market conditions and a willingness to adjust the strategy as needed, ensuring that the cash is not only present, but that it is actually working to achieve the desired financial goals. Opinion about the market. It may be hard to believe, but Charlie and I have never formed a specific opinion about the market as a whole. We believe that trying to predict market behavior is not only futile, but can also interfere with the prudent decisions we make about specific trades. Our approach is based on analyzing and evaluating each investment opportunity individually, rather than being influenced by general market fluctuations or predictions. If we identify a business that we find attractive, it would be a mistake to not act on that assessment simply because we think the market might behave a certain way. In other words, it makes no sense to trade an investment opportunity that we consider profitable for an uncertain alternative based solely on market speculation. This perspective reflects our confidence in evaluating investment opportunities based on their own merits and fundamentals, rather than on general market sentiment or forecasts. It is more important for us to focus on the quality and potential of individual businesses rather than being distracted by market movements and opinions as a whole. Diversification and knowledge. Diversification and knowledge are two central concepts in investment strategy, and the balance between them can define an investor's financial success. We are often drawn to the idea of diversifying our portfolio, putting money into a wide range of investments to reduce risk. However, this approach can be more complex than it seems, and it's not necessarily the best strategy for everyone. Investing in a variety of assets may seem like a logical way to protect yourself against potential losses, since the idea is that if one investment doesn't do well, others can make up for it. However, this diversification can become a hedge against ignorance rather than a strategy based on real investment knowledge. When we limit ourselves to diversifying, we can end up investing in companies and sectors that we have little or no knowledge about, which can result in less informed decisions and, consequently, less effective investments. For those who have the skills and knowledge to analyze companies and markets in depth, over-diversification may be unnecessary. Investing in a large number of stocks or assets can dilute the impact of truly solid, well-researched investments. Instead, Focusing on a few exceptional businesses and investing heavily in them can be a much more effective strategy. True, lasting wealth is often built from a deep, specialized knowledge of a few carefully selected investments, not from an overly diversified portfolio. True value comes from deeply understanding a few exceptional companies, their business model, growth prospects, and market position. By investing in businesses that you truly understand and believe in their potential, you can make more informed and strategic decisions that can lead to more significant and sustainable returns over time. In short, diversification should not be a substitute for knowledge and in-depth analysis. It should be a complement to the ability to identify and invest confidently in opportunities that truly stand out. Risk and volatility measures. In the investment world, volatility is often confused with true risk. While volatility is a useful measure for understanding how an asset's price changes over time, it does not fully capture the risk associated with an investment. Beta, for example, is a metric that measures the volatility of an asset relative to the broader market. However, beta does not necessarily reflect the true risk of an investment because it is based on historical price changes and does not take into account the specific nature of the asset or the economic context. Past volatility, while informative, is not a reliable indicator of future risk. Market dynamics can change and economic conditions can evolve, making past volatility an inaccurate reflection of future uncertainties. For example, in agricultural land investments, the perception of risk can be distorted. Volatility may be high at times due to seasonal factors or unexpected events, but this does not capture the true nature of the risks associated with the agricultural sector, such as changes in agricultural policies, weather variations, or fluctuations in commodity prices. To truly understand risk, it is essential to analyze the nature of the business and the economics involved. This involves considering factors such as the sustainability of the business model, the ability to adapt to economic changes, and the impact of external factors. Rather than relying solely on mathematical metrics such as volatility, it is crucial to take a holistic view that considers the operational reality and industry-specific risks. This approach provides a deeper understanding of the true risk associated with an investment and helps to make more informed and strategic decisions. Temperamental quality. In the world of investing, temperamental qualities are often more crucial to success than pure intelligence. While a high IQ can be an advantage, it is not a prerequisite for excelling in the investment field. What truly sets successful investors apart is the ability to maintain a stable personality and not be swayed by popular opinion. Temperamental quality refers to the ability to remain calm and focused, even in the face of volatility and uncertainty. Investors who have a balanced temperament are less susceptible to making impulsive decisions based on emotions or market pressure. Instead of following the flow of the crowd and making decisions based on passing trends, these investors have the ability to think independently. Maintaining a clear and objective view is essential. This means evaluating opportunities and risks based on data and sound reasoning, rather than relying on hearsay, overly optimistic forecasts, or pressure to act on market sentiment. Investors with a good temperamental quality know that success in the market often requires patience and discipline, as well as a deep understanding of the underlying fundamentals of the investments they are considering. Furthermore, these investors are able to resist the temptation to change their strategy frequently just to align with market fluctuations. They understand that investment decisions should be based on rational, well-considered analysis, rather than on momentary reactions to current events. Therefore, temperamental quality involves the ability to remain centered, control emotions, and make informed decisions based on objective analysis. It is this emotional stability and independence of thought that often translates into long-term success in the world of investing. Investment in yourself. The best investment you can make is in yourself. When we talk about investing in yourself, we are referring to the continuous improvement of your skills and personal development. Among these skills, communication skills are extremely important. Being able to communicate your ideas clearly and effectively can significantly increase your personal and professional value. If you are unable to communicate your ideas effectively, it is like trying to wink at someone in the dark. The message will not be received as you would like. Investing in developing skills such as communication not only improves your daily interactions, but also opens doors to new opportunities. Effective communication is a differentiator that can impact every area of your life, from your career to your personal relationships. Furthermore, this type of investment is immune to external factors and can be continually improved. By investing in yourself, you are creating an asset that no one can take away from you. This is an investment that appreciates in value over time and provides lasting benefits, making it essential to your success and personal growth. Asset allocation and strategy. Asset allocation is an investment strategy that is often presented with rigid formulas, such as keeping a fixed percentage of money in stocks and bonds, for example, 60% in stocks and 40% in bonds. However, this approach can be seen as an outdated concept and even ineffective in certain contexts. The problem with this strategy is that it can limit the flexibility needed to adapt to market conditions and opportunities that arise. Rather than following predefined formulas, it's best to take a more dynamic and responsive approach. Holding a position in short-term instruments can provide liquidity and flexibility, allowing you to seize investment opportunities as they arise. True investment expertise comes not from following rigid rules about asset allocation, but from knowing when and how to invest based on careful analysis and a deep understanding of the market. Traditional asset allocation can often be seen as a marketing ploy to create the impression that investment management requires expert intervention. In reality, the ability to identify and respond to investment opportunities is far more valuable. Successful investors are those who are able to adjust their strategies as circumstances change, rather than sticking to fixed allocations that may not reflect the best opportunities available at the time. Therefore, the ideal approach to asset allocation is one that is adaptable and guided by ongoing analysis of the market and opportunities. Investing based on knowledge and flexibility, rather than following predefined formulas, can result in better returns and a more effective and successful investment strategy. Propensity to gamble and bet. The human propensity to gamble is a remarkable characteristic of human nature, evidenced by the universal appeal of gambling and risk. Many people are attracted by the potential for large gains in exchange for relatively small investments, an attraction that is reflected not only in casinos and lotteries, but also in day trading. This type of short-term trading in financial markets often resembles gambling, where investors are driven by the possibility of quick and substantial profits without adequately considering the risks involved. The ease of access to gambling, as demonstrated by the legalization of casinos in several regions, has a direct impact on increasing people's participation in gambling. Aggressive marketing and the constant availability of gambling options mean that many people get involved without fully considering the financial and emotional consequences. This ease of access can increase the frequency with which people gamble and the severity of associated problems, such as addiction and financial losses. Gambling, often described as a tax on ignorance, exploits a lack of understanding of the probabilities and risks involved. The idea that one can win big prizes quickly and easily is an illusion that distracts from the real odds of losing. It is socially troubling and even outrageous when governments, rather than protecting their citizens and promoting welfare policies, exploit these human weaknesses. Rather than providing support and education to help individuals make more informed financial decisions, the legalization and regulation of gambling often profits from participants' losses, contributing to a cycle of exploitation and vulnerability. The ideal approach to addressing gambling addiction involves financial education and awareness of the associated risks. It is crucial that public policies not only regulate gambling practices, but also promote accountability and provide resources for those struggling with addiction. The focus should be on protecting and educating citizens, rather than exploiting their weaknesses for financial gain. Growth versus value. The relationship between growth and value is often misunderstood as two completely separate categories, when in fact they are intertwined and part of the same investment equation. The rigid separation between growth and value stocks, often promoted by Wall Street analysts and strategists, fails to capture the full complexity of this relationship. Growth is a factor that can potentially add value to an investment, but this only happens when it results in returns that exceed the initial investment. The true benefit of growth is measured not simply by increased revenues or business expansion, but by the ability to generate returns commensurate with the capital invested. In other words, growth is positive for value when it translates into significant financial returns for shareholders. The way a company grows and the relationship between the investment required for that growth and the returns obtained are crucial to assessing the quality of the investment. sustainable and well-managed growth can be extremely beneficial. For example, the case of See's Candy illustrates how growth can be a valuable asset, as the company has been able to expand its market presence and grow profits effectively, generating solid returns for its investors. However, growth is not always a positive sign. There are situations where growth can be detrimental, especially when it is associated with high costs and low profit margins. The example of airlines demonstrates that while an industry may be expanding, this does not necessarily guarantee a positive return on investment. Airlines often face significant challenges such as high operating costs and intense competition, which can limit the benefits of growth and negatively impact shareholder value. Therefore, when considering investments, it is important to assess how the company's growth translates into real value. The analysis should focus on the effectiveness of growth in generating financial returns greater than the initial investment, considering both the opportunities and the associated risks. Balancing growth and value is essential to identify good investment opportunities and ensure that the invested capital produces the expected returns.